I'm Share Navigator, and today we're going to talk about how dividends can impact your portfolio and how to understand them. So, just a couple of things we're going to talk about. What's a dividend? How and when are dividends paid? What is the ex-dividend date? What is the dividend yield? What is the dividend payout ratio? And finally, we'll just talk about a couple of things you need to look out for with dividends. So, we'll get straight into it. So, what are dividends? Dividends are simply payments made from companies to shareholders, and it's usually paid out of company profits or excessive cash that can be sitting in the bank account. And it's really considered a way of rewarding shareholders for investing into the company. How and when are dividends paid? Well, dividends are usually paid once per year for European stocks and once per quarter for US stocks. If you own shares of a company through an online broker, for example, the dividends usually just go straight into your account, your trading account. On the flip side, if you own share certificates, dividends are usually posted out to you from the company, and it's usually by way of a check. So the ex-dividend date, when you look at a company on a financial website, for example, you'll see two dates for dividends. One is the ex-dividend date and the other is the dividend date, or sometimes it's known as the payout date. And the ex-dividend date is the most important one. That's the date you must own those shares by in order for you to get your dividend payout. So for example, if the ex-dividend date is the 1st of January, you must own those shares by the 1st of January in order to get paid the dividend. The dividend date is actually the payout date, and that's normally about 4 weeks after the ex-dividend date. So that's the date you actually get your money. So there's the two key dates you need to be aware of. Now, this is the most important part of a dividend that you need to understand. It's the dividend yield. A lot of people focus on the dividend amount, but it's actually the yield that you should be focusing on. And the yield is simply the dividend amount divided by the current share price. So let's give you an example here. A company called Pfizer, it currently pays a dividend of $1.12, and the share price of Pfizer is $31.25. So it's the 2nd of February, so at the time of writing, that's the share price of Pfizer. So therefore, the dividend yield is $1.12 divided by 31.25, which is 0.03584. To get that into percentage terms, just multiply by 100, and it's 3.584%. So what does that mean for you? Well, for every €1,000 or $1,000 that you invest into Pfizer, you're going to get 3.584% of that as a reward for just owning the shares of Pfizer. So most financial websites actually give you the dividend yield. You don't need to know how to calculate it, but it's just something that is nice to know for you. So the next thing you need to be aware of is the payout ratio. And the payout ratio is the percentage of profits paid to you by way of dividends. And the reason it's important is because if the payout ratio is too high, you're going to have to ask yourself the question, is it sustainable for this company to keep paying you that dividend in the long term? And it's simply calculated by the dividend amount divided by the earnings per share. So that's the dividend payout ratio. A couple of things to watch out for dividends. Always look for the dividend yield, as we said, not the dividend amount. If you want a dividend paying company in your portfolio, you need to check that the company has a long track record of paying dividends. A company that pays a dividend, let's say in the last year or two, and didn't pay a dividend before that, doesn't have a track record. And what we mean by a track record is at least 10 years of paying a dividend. You would also want to see at least out of the last 10 years, at least 7 or 8 of those years increasing the dividend amount payable every year. So for example, with Pfizer, they've paid out $1.12. You will want to see that increasing next year, maybe to $1.16. And make sure that the payout ratio is practical and consistent. A payout ratio that's too high, so for example, if you see a payout ratio above 100%, that means that a company is given more than the profit it made for that year out to the shareholders by way of a payment. So it's actually going into its bank account to take money out of the bank account. That's not sustainable in the long term. So you want to make sure that it's a consistent payout ratio over the last number of years. And the final thing you need to know is many companies, Apple being one of them, Ryanair is another, they pay off every now and again a big dividend to reward shareholders. So they have excess of cash sitting in the bank and they're saying, how are we going to reward our shareholders? They pay out a big, huge dividend every now and again. Just be careful of that because that doesn't mean they're going to pay it out every year. So when you're factoring in whether a company is right for you, make sure that you're not factoring in the once off big dividend as well. Okay, my name is Stephen Cox from Share Navigator. We train you to manage €50,000 of our capital in the stock market, risk free for you. If you'd like to know more about that, just go to our website. Thanks and bye for now.